Good afternoon, investors. Welcome to the first part of our Brick by Brick webinar series, where you'll learn the basics of REITs and how to invest in them. But just a reminder to all our participants before we begin, please keep your microphones muted during the entire session. And if you do have any questions, please send them to us through the chat box or comment section, and we'll address them later during the Q&A section. So my name is Franco Fernandez, one of Dragonfly's researchers, and I'm thrilled to be here today with Lance Guy, who is also part of our Dragonfly research team. So without further ado, let's dive right into it. So Lance, what are REITs?
Okay, so REITs or real estate investment trusts are companies that own, operate, and finance income-generating real assets like buildings, malls, or plots of land that can be leased out to hotels, resorts, and solar farm operators. By investing in REITs, you can easily participate in the real estate market, which was usually only possible for those with high capital.
Can you actually name any of these buildings or malls that we might know that's part of any REIT?
Sure. Glorieta 1 and 2 for a REIT, and also you have RCR's Robinson's Equitable Tower. It's an office building within the Ortigas Central Business District.
Is that the one by Galleria or the one
Yeah,
near
right.
Poveda, right?
Yeah,
Yeah.
it's the one.
Okay, cool.
So moving on, how do REITs work? REITs are publicly listed in the PSE and allowing investors to buy shares and own a fraction of the REIT's real estate portfolio. So for example, try to visualize a REIT, Ayala's REIT company. Diba they have malls like Glorieta 1 and 2 sa Makati and office buildings like the Vertis North BPO Tower sa Quezon? Those only comprise a small part of their entire portfolio. Pero if you own shares of a REIT, you are entitled to receive a portion of the rental income they generate from their properties. You earn them through dividends arising from their distributable income. Okay, let's look at this simplified diagram on how it works. In the Philippines, REITs start with a sponsor who transfers income-generating real estate assets into the REIT. In return, the sponsor receives equity ownership through shares. Investors naman invest their money in a REIT when they buy the shares mismo on the stock exchange. The REIT company uses both the sponsor and the investor's money to operate and expand their portfolio. Now, how do you benefit from this? Easy. Through dividends. The REIT earns rental income from its properties, and every quarter, the REIT will distribute 90% of its distributable income to shareholders. So let's move on to the REIT Act of 2009. This is RA number 9856. So what this is REITs are formed and operate based on the REIT law, and it's implementing rules and regulations. The main purpose of the REIT law is to allow anyone to participate in the ownership of real estate. So here are some of the important things you need to know for the REIT law. The first is that REITs must invest at least 75% of its assets or property in income-generating assets. Second, and probably the most known and advantageous thing in a REIT is that they are required to distribute at least 90% of its distributable income as dividends to shareholders. Sometimes a REIT can pay out more than 90% every year, and that can be a good thing for investors, providing you with good passive income. But you know what I find interesting, Franco?
What?
The REIT law was passed in 2009, pero we didn't have our first REIT until 2020. Do you wonder why that is?
Yeah, actually, I thought about this before. So it's an interesting history lesson, actually. So in 2009, when it was first passed, the two main hurdles that any would-be REIT would have to go through is a 12% value-added tax that property developers like Ayala Land or Robinson's Land would have to pay to transfer their properties into a REIT. So imagine a 12% VAT on billions worth of assets. That can sum up to a large amount. So, and then the other one is that the REIT must increase its minimum public float to 67% by its third year. So these two hurdles discouraged any would-be REITs, as they would have to spend more and sell much of their ownership in their REIT early on. But eventually that changed with the train law. And what the train law did, it made REITs exempt from VAT, so meaning they were tax-free from VAT. Then the implementing rules and regulations were then revised to lower the public float to only a minimum of 33%. So those changes revived our REIT market, and it finally came to life.
Thanks for enlightening us with that. Let's move on. How do REITs grow?
Okay, so REITs grow primarily in two ways, through organic growth and inorganic growth. The first one is organic growth, which refers to the growth of a REIT's revenue and profitability through internal improvements and enhancements to its existing properties. So that means rent escalation, improving occupancy rates, which can be done through like targeted marketing campaigns, leasing incentives like discounts or flexible lease terms that would entice more tenants, or obtaining LEED or EDGE certifications to attract environmentally conscious tenants. The property enhancement and development is another one, which means renovating spaces and units with, like, for example, modern design, improving common areas, adding more facilities, and having a sustainability initiative like reducing energy and water consumption, for example. The other one is operational efficiency, which means finding efficient ways to reduce the cost of managing properties. And the last one is about consistent lease renewals, which is more on proactive lease renewal strategies, meaning that these REITs are able to get behind these lease agreements before they expire with favorable terms, so that they limit the vacancies that might arise if they do not renew their leases. The next one is inorganic growth. This one involves expanding a REIT's portfolio and income through acquisitions and mergers. This is probably the best way a REIT can grow and how we as investors can earn more dividends. So the one method that most of the REITs have done in the Philippines is through property acquisitions. So it's either through a cash acquisition or a property for share swap agreement. So for those who are updated with the news, you'd see that MREIT and AREIT have done this kind of thing already. The other ways, although it hasn't been done yet, is through mergers and acquisitions with other REITs or real estate companies, the development of new buildings or properties, and joint ventures and partnerships with other REITs or property developers. Now, on the next slide, I have an example of this inorganic growth through property acquisition. So I'm using AREIT as an example. As you can see, with every acquisition, AREIT's dividend per share increases. So despite the dilutive effects of a property for share swap agreement, wherein AREIT would have to issue more shares to satisfy the agreement and maintain its public float, there's not too much of a concern when it comes to dividends. Why? Well, because those properties that AREIT has added to its portfolio will eventually start generating more and new rental income, which will flow into its dividends. So as you can see, with every quarter following its acquisition, the dividends were higher. So now with all this information, should you invest in a REIT, or maybe would you want to invest in real estate? So Lance, care to fill us in on this?
Sure. So let's start by looking at their fees. Okay, so here's the general overview of the fees associated when you deal with real estate and REITs. So sa real estate, diba, you have different kinds of fees, pero it depends on what you're doing with the property. So if you're a buyer, you have documentary stamp tax, transfer tax, registration fees, and notarial fees. Pag owner naman, real property tax, it's annual, and income tax if you're renting it out. Tapos capital gains tax and brokerage fees naman if you're the seller. It's pretty big kasi the percentage here is a fraction of the property's selling value or market value. Pag sa REITs naman, they operate naman kasi exactly the same lang with dealing with non-REIT shares. Kasi in the end, they're still shares. The way the business operates lang is different. Total fees for buying equates to 0.295% and 0.895% for selling, much lower than the fees for real estate. Okay, so real estate's passive investing comes from the income earned from renting out your unit. Pero depende pa yan sa lease contracts or renewals and demand for it.
Also, actually, in case you guys didn't know, when it comes to the brokerage fees, Dragonfly actually removed the minimum 20 pesos. So now, when you invest in REITs with us, you only have to pay a commission of 0.25%. So there's no such thing as the 8K rule anymore here at Dragonfly. So if you invest a stock worth 1,000 pesos, instead of having to pay a minimum of 20 peso in commission, it will be now 2.5 pesos. So a lot of savings from that.
Yep. Okay, after fees, let's move on to comparing them mismo. So here, the passive investing ng real estate comes from the income earned from renting out your unit. Pero depende nga yan sa lease contracts or renewals and demand for it. REITs, on the other hand, have dividends naman that mainly come from the rental income ng company. How big your dividends are depend on the number of shares you have and the performance of the REIT. How well the REIT operates for the year yun. And next, we have liquidity. So this means how quick it is to sell. So pag real estate, diba, it's difficult to buy and sell. If you have it, you need to find a buyer pa, and that takes a long time. Tapos you have the fees pa para sa ahente. So it's really costly talaga. But for REITs, it's high, very, very liquid. So it's easy to buy and sell. It's listed in the PSE. So you could trade the shares mismo. Ito, big point of comparison, capital requirements. If you want to invest directly in real estate, you'll need millions eh.
Nance, do you have millions? Can you buy me a house?
Not right now. Maybe in the next 5 years. For affordable to mid-income condominiums kasi, you'll need about 2.5 to 12 million. And pag high-end, you need upwards of 20 million. So unless you've saved enough for years, or anak ni Henry C., you wouldn't be able to buy agad. Tapos financing options are really expensive rin. They get more and more expensive the more you drag the period. So, yun. Pag sa REITs naman, it's not expensive eh. You only need 1,000 pesos, around 1,000 pesos to start, depending on the stock price and board lots. Okay, so the last point of comparison is the way these two are controlled and managed. So for real estate, may mga management and maintenance fees tayo. So yung mga associations, repairs, and utility fees. But the good thing here is you have total control of your property and the decisions you make with it. Sa REITs kasi, yung management, sila na bahala with the properties. So di siya hassle, but you won't have a say regarding their plans for the properties and how they move on with the company. Okay, moving on. Take a look at this data from a recent report by Colliers. Rental rates for a condo unit in the main business districts declined since 2020, while the secondary market vacancy rate in Metro Manila has been rising since the pandemic. So what's my point? It's mostly about diversification. I'm not trying to discourage any investments in real estate. If you have the capital, it can be a very profitable investment. I'm just pointing out na most likely, as an individual investor, syempre bibili lang tayo ng mga residential properties. If you only invest in residential properties, you're concentrating heavily on just one segment of the real estate market. So in times that the sector suffers, parang dito, you'll really feel the brunt of it. For REITs kasi, they usually spread out their portfolio. So for example, sa A-REIT, they have offices, malls, hotels, and industrial lots. So if hotels fail to deliver, they would still have other properties to support yung company. This is just something to consider when investing in real estate versus REITs. So Franco, what are the important metrics sa REIT? What do we look out for?
Okay, so to analyze and compare REITs, you must remember these metrics. So starting with distributable income. So distributable income refers to the portion of a REIT's income available to be distributed to shareholders. It is the profit generated by a REIT, but it excludes or adds back non-cash items like fair value changes in investment properties. A breakdown of this can always be found in their annual or quarterly reports. The importance of knowing the distributable income is one for dividend guidance. It gives you a clear picture of how much income is available to be distributed to shareholders as dividends. Because if you recall earlier that the REITs are required by law to distribute at least 90% of their distributable income to shareholders. So, for example, if a REIT has a distributable income of 100,000 for the quarter, and then it must declare 90,000 worth of dividends. The other one is for financial health. It gives you a clear picture of a REIT's financial health and ability to generate cash more so than net income because it accounts for the non-cash expenses. So for a better visual example, I will be using C-REIT's quarterly dividend report. So as you can see on the the slide, the distributable income of C-REIT for the fourth quarter of 2023 amounted to 333 million, while the dividend distributed amounted to 351 million. That's equal to a 105% payout. So actually, C-REIT is the only REIT that has been able to do this, pay out more than 90% consistently every quarter. And the reason why, even though it's so high, it's because it's still it equates to 100% of the adjusted funds from operation, or AFFO, which is just another measure of cash generated for the period. So the next one is the gross leasable area, or GLA for short. This refers to the total floor area available for rent to tenants. This is a space that the REIT can rent out. It only includes rentable space that, so like within a property like an office building, a mall, industrial park, or land. It generally excludes hallways, lobbies, and maintenance rooms. So most likely it's those shared facilities that they don't include. So the importance of this is because a larger GLA would mean more leasable space that the REIT can rent out, increasing the potential rental income. It can provide information. It can also provide information on the diversification of a REIT's property, or tenant diversification. So the total GLA and its distribution across sectors or tenant types provides insight on how well that portfolio is diversified. So a well-diversified portfolio mitigates the risk associated with a specific sector or property type, like a office building, a mall, or the BPO sector, and for example. Now, here's an example on the next slide. So this one is a breakdown of MREIT's GLA. So this was taken from their 2023 annual report. So if you can see on the green rectangle on the screen, it shows you the breakdown of GLA of each of its buildings, the leased area, and the total amount at the very bottom. So at the end of 2023, MREIT has a GLA of 325,000 square meters. On the next slide, I have another example. It's about AREIT's portfolio diversification. It's taken from their 2023 briefing report. So as you can see in the green rectangle, 63% of its total GLA is leased out to office spaces, with retail being the next biggest of 24%. So knowing this provides insight on whether or not the REIT is heavily weighted towards office, which would mean higher risk towards like BPOs or the office segment. Next is something related to GLA. It is the occupancy rate of a REIT. So it is the percentage of a property's gross leasable area that is currently rented out. So it is, the way you compute this is occupied space divided by the total available space times 100. So it will give you a percentage. It indicates how much of the REIT's properties are occupied by tenants. The higher, the better. So the higher the occupancy rate, it generally means higher rental income, which is important for paying higher dividends. Higher occupancy rate also suggests that there's strong demand for the property, indicating maybe a desirable location or a quality property management. This also can lead to higher rental rates and better tenant retention. Now, of course, why this is also very important, because we as investors we can use these occupancy rates to compare the performance of different REITs. So a REIT with a higher occupancy rate compared to its peers might be seen as a better investment due to its ability to generate higher rental income and attract and retain tenants. As an example, and going back to MREIT's portfolio of properties, we can see at the very last column, the average occupancy rate at the very bottom is 96%. And then it also shows you the breakdown of the occupancy rate of its other buildings as well. So you take the average and you arrive at 96%. So the next one is the weighted average lease expiry, or WALE for short. So this next metric is used to measure the average time left until the leases of a property or portfolio of properties expire. It is normally weighted by the rental income or the leasable area. So why is this important, and why should you remember this? It gives investors an idea of the stability and predictability of future rental income. So the longer the WALE, the better, the stable and predictable the income is. And it reduces also the risk of vacancies and income volatility and also tenant turnover. So a shorter WALE would mean the opposite. So it suggests that leases are nearing expiration, which could lead to higher tenant turnover and unnecessary costs associated with that, and the potential of vacancies. So this increases the risk for investors as it might impact the REIT's rental income if tenants do not renew their leases, and that will affect our dividends. So using a REIT again as an example, overall, its properties have a WALE of 10 years. So that means on average, A-REIT's tenants have about 10.1 years before their leases expire and before A-REIT would have to go to them and ask if they want to renew. Next, we have the rent escalation. This is the last last metric for a REIT that you should remember, because it refers to the contractual or periodic increase in rental rates over the lease term. So this can be fixed annually for a specified number of years or negotiated periodically. So rent escalation ensures that the rent keeps up with inflation, the property value, and other factors that a REIT might consider. So the reason why this is important, it provides also a predictable increase in rental income over time, helping the REIT pursue organic growth and dividend increases. Another is that it provides investors with protection against inflation, ensuring that rental income maintains its real value over time. And lastly, a well-structured and fair rent escalation can attract tenants who become more willing to commit to longer leases because of fair rent escalations, which enhances the rental income stability of a REIT. So example, I got this from, on the next slide, I got this from Phil REIT's website. So Philinvest REIT has an annual average rent escalation of 5% per annum. So you can find all this information on the website, on the annual reports or quarterly reports of REITs, but also you can also find this information when you join our investing club and access our research reports, because there we provide you with all these metrics for all these REITs. We just have to right now we're working on updating all of them. So yeah, stay tuned for an update. But as of now, our presentation provides the updated metrics for the REITs that I'll be discussing later. And also, if you want to know what REITs to invest, we also have our investing club trade alerts, where we issue trade alerts for any of the REITs we buy for dividend investing. So recently, we actually bought C-REIT and RCR. So you can check that out in our investing club. We also have our creator circle, which gives you easy access to the best financial influencers in the country. And I know most of them discuss REITs and what they are and which REITs to invest in. So if you have an account, please check it out in the Dragonfly mobile app. If not, feel free to create an account with us. Now, let's move on to the next. Who are the REITs? So here we have 8 REITs in the Philippines. Lance, do you know what the first REIT was in the Philippines?
It's A-REIT, no? Ayala's REIT.
Yes, that's correct. That is A-REIT. A-REIT is the first and the fastest growing REIT in the country. It is backed by the Ayala family. Its main sponsor is Ayala Land. So just here for a quick rundown on its the important metrics. So A-REIT has 25 investment portfolios with a total asset under management of 87 billion pesos. That's 3 times more than its initial asset under management when it first IPO'd. Its GLA grew to 918,000 square meters recently because of its recent acquisition last July of 2023, where it acquired Ayala Avenue offices. It's the Glorieta 1 and 2 BPO Mall and the Marquee Mall. So next, we have the occupancy rate of 97%. And the breakdown of that will show you that 63% belongs to offices, 11% to industrial lots, retail 24%, and hotels at 3%. So it's also not done growing. If you manage to look at its latest briefing report, you'll see that it's planning to infuse about 7 more properties this year, and it will add, I think, if I'm not mistaken, 2.9 million square meters. Most of it, of course, will come from its provincial land in Zambales, which I believe will be used for industrial operations. I think it's a solar operation, but you guys can check that out for yourselves if you don't believe me. Now, it has a WALE, as mentioned earlier, of 10.1 years, and a rent escalation of 2.5 to 5%. And just an added information, for its non-cancelable leases, it has a rent escalation of 5 to 10%. Next, we have the Gokongwei-led RCR. So for this one, it is a BPO-centric REIT with an all PEZA-accredited portfolio. So it has 16 investment properties. All of them are PEZA-accredited, with some of them having LEED or EDGE certifications. So it has a GLA of 480,000 square meters, an occupancy rate of 94%. Now, it's mainly office with 77% for BPOs, 11% for traditional offices, and 12% for others. Next, we have the TAN's MREIT, a fast-growing office tower REIT. So the main sponsor of MREIT is Mega World Corporation. It has 18 investment properties, and based on the latest news report, it plans to acquire 6 new office buildings worth 13 billion, which will increase its GLA to 480,000 square meters, or increase it by 150,000 square meters from the current 325,000 square meters by the end of 2024. So that puts them close to their 500,000 target by the end of 2024. So we can expect to see some dividend growth with MREIT. Now, the occupancy rate is 96%, with most of it also, like similar to RCR, BPOs, with 22% to traditional offices and a small percentage for retail and hotel. It has a WALE of 2.8 years and a rent escalation of 5 to 10%. Next, we have the Gotianon family's Philinvest REIT. So Phil REIT is actually, or claims to be, the first sustainability-themed REIT with a grade A portfolio, because 13 of its buildings enjoy 100% renewable energy supply. It is also the REIT with the most LEED and EDGE certifications in its portfolio. Its main sponsor is Philinvest Land. It has 18 investment properties, but 16 of those properties are located in Alabang, one of that office building in Cebu, and one in Boracay, where it is leased out to the Crimson Resort and Spa. It has a GLA of 330,000 square meters, an occupancy rate of 83%, again, most of it going to BPO space, and 9% to traditional offices. And what's actually interesting about Phil REIT is that it is the only REIT that has a breakdown, has a space dedicated to co-working spaces. So that's pretty interesting. Next, we have DDMPR, Edgar Injap CS REIT. It is an office and commercial REIT. Its sponsor is Double Dragon Properties Corporation. It has a portfolio of 3 commercial properties, which consists of 6 office buildings, office towers, with a retail component. So how it works is, like, if you go to, for example, Double Dragon Plaza, if you go to the ground floor, it's all retail space. It's all like Jollibee, Mang Inasal. And then and then all the floors above it are all for office. So it has a total GLA of 172,000 square meters. It is mostly for office spaces, with a small amount for retail. It has an occupancy rate of only 76%, a WALE of 2.6%, and an average rent escalation of 5% per annum. Now, next, we have the only mall-centric REIT right now in the Philippines. It is the REIT of the Villar family. Its main sponsors are subsidiaries and affiliates of Vista Land and Lifescapes Incorporated, like Manuela Corporation or Crown Asia Properties, if you guys are familiar with those. It has a portfolio of 12 investment properties, 10 of which are all community malls. So like Vista Malls, Star Mall, those are in its portfolio. And it has two office properties, one in BGC, if I remember correctly. It has a GLA of 256,000 square meters, most of it for retail and some for office. It has an occupancy rate of 97%, a WALE of 4.1%, and average rent escalation between 5 to 10% per annum. Now let's move on to our energy REITs. So the first energy REIT is C-REIT. It is the country's largest renewable energy landlord. It is the REIT of Edgar Saavedra. Its main sponsor is Citicorp Renewable Energy Corp, or CREC, which is actually going to IPO next month. So that's something to be excited about. Its tenants are plant operators or companies of the Citicorp Group. They have a total installed capacity of 145 megawatts. So the reason why they can maintain 100% occupancy rate is because the operators are part of the Citicorp Group, and it's very hard to move a solar farm from its land. So you can expect 100% occupancy rate for, I guess, for the foreseeable future, if everything goes according to plan for C-REIT. It has 14 leasable properties, a GLA of 7.1 million square meters, the highest WALE of 21.4 years, and a rent escalation of 2 to 3% every year. So the rent escalation you can expect to be lower in the provincial areas. And finally, we have another Villar-led REIT, Premier Island Power REIT, which is P-REIT for short. It is both a renewable and non-renewable energy REIT. Its main sponsor is SI Power Corp and Camotes Island Power Generation Corporation, or Sitcor and Campcor for short. It has a total installed capacity of 21.2 megawatts. So right now, I believe that they only have heavy fuel oil fired power plants in their locations, and some power asset plants like a water treatment unit, all water separator. But they are currently working on their renewable energy portfolio. So it has 8 leasable properties, 4 of which are located in Siquijor. It's for Sipcor, and 4 properties located in Cebu for its Capcor power plants. It has a GLA of 30,000 square meters, so not as big compared to C-REIT, but it also has an occupancy rate of 100%, a WALE of 8.3%, and a rent escalation of 3%. So next slide. Here's a summary of what I've just discussed. So you can feel free to take a screenshot. This is updated as of December 31, 2023. On the next slide, we have the performances of these REITs. So since its IPO, if you invested in A-REIT, P-REIT, or C-REIT, and V-REIT, you would be up, because it includes, this refers to the total income, total return of these REITs. So that includes all the dividends since its IPO. But for year to date, if you invested only this year, starting this year, the biggest winner would be P-REIT, followed by Phil-REIT and C-REIT. On the next column, you have the trailing 12-month dividend yield. So this is also an important factor to consider when you invest in REITs, because the interesting thing about REITs is that you want to invest in a REIT that provides a yield higher than the 10-year bond. In the Philippines, I believe it's 6.78%, I think, yeah. So when you make an investment in REIT, you want to have the dividend yield of your REIT be higher than that, because otherwise you can just go to that, you can go to a bond because it will offer you the same yield for less risk. And then on the last column, you have the minimum investment amount, net of fees. So as you can see, RCR is actually the cheapest because it has a minimum board lot of 100, and its current price as of May 17 is 5.10 pesos. So it really does not take a lot to invest in REITs. You can really start with less than 1,000 pesos with RCR, and you can move your way up to like 1,000, 2,000, and so forth. Next slide, please. And finally, just another plug. So we have tools in Dragonfly that will help you invest in REITs. So we have the dividend screener, and then we have the price finder. The price finder and the filter. And of course, we have the market calendar, which allows you to keep track of all these of the upcoming dividends. Next slide. Okay, so now we have a demo actually to show you how to invest in REITs with Dragonfly's mobile app. Okay, so now you can see it. So here we're on the dashboard, right? So before we can invest in a REIT, there's tools, as mentioned earlier, that we can go through. So starting with the dividend screener. So here in the dividend screener, you can search for the REITs on the search bar. So I'll type REITs, and all the REITs will show up. So as you can see, there are 8 REITs here. You can view their last price, their performance for the day, their dividend yield, and their dividend yield if they have special dividends. But normally REITs haven't given any yet. And you also have the current dividend. So here with the dividend screener, you can look at all these information and other financial metrics that might be helpful for you to invest in a REIT. And then if you, for example, click on a REIT's view history, you can view the past dividends that a REIT has paid out since its IPO. You can click on it, and you can see the X date, the dividend yield, and the type. Now, another way of knowing which REITs to invest in is through the investing club. So here we have our research and analysis of REITs. The latest one I believe that we have was for C-REIT. We basically updated it with the quarterly report here, for example. So you guys can check that out for yourselves. And then another one is we have the trade alerts. So recently we bought RCR and C-REIT. So if you want to know why we bought it, you can read our reports here. But generally, we believe that the current yield that it offers is very nice, and that the vote of confidence from SM's investment and GSIS investment in RCR is also another good sign. Anyway, so back to the matter at hand. How do you invest in the REIT? So stocks, you click on stocks. Here you can search for any REIT you want to invest in. For example, a REIT. Here you can click on a REIT. Then you click on buy. So here, when you're on this page, you have an order form. You will see the quantity and limit price. So if I, for example, want to invest, so the minimum barred lot for a REIT is 100 shares. It has a current last traded price of 33.55. So if I click on next, I can see the breakdown. So see, without the minimum 20 peso commission fee, our commission is now only 9.40 pesos. So if you're content with this and you want to proceed with your investment, you click on confirm. But unfortunately, the market is closed. So what would normally happen is, if you go back and you click on orders, your order will show up here. So instead of Globe, for example, it will say a buy of 100 shares of Globe. It would say working if the order hasn't been filled, and completed if you have been filled. And if you click on it, there would be a button here that would allow you to edit your order or cancel it. Yeah, so it's very simple to invest in the stock. So again, just as a recap, you search for the stock, you click on the ticker, you click on buy, and then you fill out this order form. I hope you guys get it. And I hope you guys invest with Dragonfly.
Thanks, Paps, for that last part. To build on what you've just learned, Dragonfly account holders will receive our exclusive weekly newsletters packed with the latest news, updates, and expert insights. If you haven't joined the Dragonfly community yet, we encourage you to download the app and create an account today so you never miss out. Now, let's start the Q&A segment. Please don't hesitate to submit your questions in the comment section or chat box, and we'll make every effort to address each one.
Yeah. So let's have the first question.
What are the pros and cons of investing in a REIT?
Okay, so the pros and cons. So starting with the pros, the first advantage is cost effective. It's very cheap to invest in REITs because it doesn't require a lot of money. Another one is the dividend stream. It pays out 90% of its distributable incomes to investors, so you can expect consistent dividends. The other one is liquidity, because it trades like a stock, so you can easily buy and sell your shares. and of course, it provides diversification. The cons are because it distributes 90% of its income, it has limited reinvestment capital. So it would have to rely on debt or property for share swap agreements in order to finance its expansion of portfolio. The other one, it's susceptible to property market risk because it still falls under the property sector or real estate market. It's also very sensitive to the changes in the interest rates.
Okay, so next question. Should I invest in all the REITs since they all give dividends?
Um, Actually, I don't believe you should invest in every single REIT just because they give dividends, because not every REIT is the same. They don't all perform the same. And for example, you see A REIT has been growing amazingly since its IPO, quarter over quarter growth, higher dividends ever since. But if you bought another REIT, which I won't name, you can notice that its dividends have declined and its price has, very much has been discounted since its IPO. And if you bought that as well, you would actually be still losing money on that investment. But if you're convinced, of course, that you should hold all these REITs, then you can, but I would advise not to do so because you want to be diversified in your overall portfolio. You don't want to be overly weighted on the property sector. So even if you have dividends, you have to consider the effect on your overall portfolio, especially during times of high interest environment, slow economic growth, and the quality of management of the REIT, because as mentioned earlier, they don't always perform equally. But because we have we have REITs in the office, in retail, and energy, I would suggest, like personally, this is just based on my personal experience and my own research, I like holding three to four REITs. Two are from the office, or office have exposure to office and BPOs. The other one is for energy. Yeah.
Okay, thanks for the answer. So next, how can I tell if the REIT is a good investment?
In order to tell, as mentioned earlier, you have to look at the financial. You have to look at the metrics. You look at the occupancy rate, GLA, their future growth prospects, because with that will tell you whether or not the REIT will grow and expand. Yeah.
Okay, so next question. As a dividend investor, since there are office, solar, and other building types, is it good to invest in all REITs given their different types? Since it looks diversified, would it be beneficial to invest in these different types of REITs?
Oh, okay. Since I answered this earlier, but to restate what I've mentioned, it is not. I wouldn't say that you should invest in all these REITs because look, for example, A REIT, RCR, M REIT, Phil REIT, DDMPR. They're all their portfolios are all heavily weighted to office and BPOs. And if you held that and the BPO sector, let's say, took a hit from AI adoption, then you would feel it a lot more if you held one or two of these REITs and diversified with let's say an energy REIT like C REIT, for example. So I think that for overall portfolio diversification, you shouldn't hold all these REITs.
Okay, so next question. What is REIT public float? As an investor, would I benefit from higher or lower public float?
Okay, so the minimum public float is just a requirement of that a certain percentage of a REIT's shares must be owned by the public investors. Now, I wouldn't say it would be good or bad to have more, but I believe that if the public float was higher, that means that this REIT is more liquid. So a higher public float would mean more liquidity for the REIT because it's in the hands of the public investors, so it's easily more exchanged. A low public float, especially if it goes below 33%, that would cause the PSC to come in and suspend the stock for the breach of the REIT law. So I guess, yes, it would be better if the REIT had a higher public float.
Okay, so for the next question. will REITs be affected when there is inflation and high interest rates? Uh, if high interest rates persist, uh, ano to? How will REITs be affected when there is inflation and high interest rates that persist longer?
How will REITs be affected when REITs? Okay, so with high inflation, especially right now, it's causing the BSP, for example, to keep interest rates elevated. They're basically having a higher for longer stance. And if this persists, that would mean that we have a higher interest rate environment. And that is not good for a REIT, because it would lead to a higher cost of capital, more expense. It becomes more expensive to rely on debt to finance their property acquisitions. And if you look at most of the REITs, they haven't really acquired much debt to acquire more properties. And if you look at it, a lot of their debt to equity ratios are very low. And then higher interest rates also lead to a higher discount rate. So what that means is that the value of their properties are lower because the present value of their future cash flows are also becomes lower because of that discount rate. It also becomes a competition, as mentioned earlier, it becomes a competition with bonds. So if rates remain high, or if inflation remains high and causes rates to stay higher for longer, then it might become more favorable to hold a 10-year bond that gives you a 7% yield than a REIT that would give you a 6% yield. So it becomes a flight to safer capital investments and lower risk.
Okay, so for the next question, what are the red flags to watch out for when evaluating a REIT?
Well, that's a good question. A red flag would be a low occupancy rate. If the REIT starts divesting or selling its own properties, which thankfully none of the REITs have done. Another concern would be if a REIT hasn't done much in terms of portfolio growth. If since its IPO it hasn't expanded and hasn't given a good reason as to why it hasn't done it, then I would say that's a red flag, because how can an investor expect dividend growth if the fund manager of the REIT isn't actively pursuing property acquisitions?
Okay, so would you recommend REITs for investors who don't have time to change positions regularly and would just want to pursue a buy and hold strategy and rely on dividend investing?
Yes, I would greatly recommend REITs for investors who would want to just pursue dividend investing, because as mentioned earlier, they have the highest payout ratio for compared to any other common stock, because it's 90% of distributable income. So with that, you can expect to have consistent dividends every quarter. That is also going to be growing with every property acquisition and organic growth through rent escalation. Yeah.
Okay, so next, is it better to invest in a REIT than the stock or company sponsor?
Okay, that is actually a good question. So I would suggest, yes, I would say if you're a dividend investor, then yes, investing in the REIT is better than investing in the sponsor, because as mentioned earlier, we focus on the dividend stream with dividend investing. So the higher the payout ratio, the better. So, and with these sponsors, they tend to infuse their mature properties into their REITs. For example, Ayala Land infusing its properties to a REIT, which would increase the dividend for investors. But if you're more after capital appreciation, then it becomes a bit more, I guess, subjective, because you would have to look at whether or not the property developer or sponsor in question provides a good investment opportunity for capital gains.
Okay, so let's move on to our last question. Oh wait, no, we
Not the
don't have
last
any.
question. Okay, I will read some of the questions from the comment section. So let's see. okay, do you still consider buying when REITs prices go down, or is it okay to invest every month, or let's say every payday without checking the prices, knowing that it's a long-term investment? Okay, with that, that is a interesting and good question, because yes, if your long-term investment thesis is bullish on the stock's growth, then yes, um, the price won't really matter in the long term, but you want to have a mix of fundamental analysis and technical analysis. Now, you don't have to do this consistently or every day. You can do this every week. You can just identify strategic buy points when the REIT, for example, hits a support level. And then there you can set a limit order, and then you can forget about it and get on with your day. When REITs go down, and the yield would obviously go up because it's a dividend per share over market price. So the smaller the market price, the higher the dividend yield. So if you believe the REIT is a good investment, then yes, you should lock in that higher dividend yield because of that lower price, as long as the dividends in question isn't impacted by, let's say, lower occupancy rates or any fundamental changes to the company, right? So if that's the case, then yes, like for example, RCR and CREIT, those two REITs provided a high dividend yield when its market price was down, despite the fact that they are fundamentally sound REITs with future expansion, especially for CREIT when its sponsor CREC will IPO. Yeah. Let's see what else. What other questions there are?
We have one here.
Oh, okay.
Is it better to buy every month or to hold your money in one REIT? Or do you need to watch every month, then sell it?
Okay, for this one, if you are a long-term dividend investor, you don't have to watch it all the time. Actually, yes, you can check on it periodically. It depends on you. So you have to ask yourself, are you a long-term investor? Do I have to watch it consistently? If you're a long-term investor, I wouldn't suggest watching it every day. I would, I guess, suggest watching it, checking on it every week, every month. And yeah. Now it's not, I wouldn't say it's better to just hold one REIT, because not every REIT is the same, right? So for example, you have A REIT or RCR for office, and then you have V REIT for malls, and then you have C REIT for energy. So that would, even though it's all under the property sector, that gives you diversification within that sector. So I would say it provides some diversification and a better, I guess, stability or predictability, stability and source for dividends. That's just an example. You don't have to buy A REIT, V REIT, and C REIT. It's just an example. Do we have another question? Okay, nice.
Would you recommend suggesting the peso cost average strategy or technique for passive income REITs investors?
Yes, I would suggest that, because I remember a while ago we were talking about A REIT, how we were hoping that we'd have another follow through day to the downside, and where we would catch it and average do the peso cost average strategy, because the reason why it went down is because of the private placement that it just had. It's related to one of its property for share swap agreements earlier last year. So yeah, I would recommend peso cost averaging as a strategy for topping up on your REIT investments when on the technical side it provides an opportune time. So on like pullbacks or when it hits support levels.
Okay.
Do we have another question? Oh, here, another. Does Dragonfly have a feature to see real-time news disclosures related to portfolio holdings? Yeah, I believe we do. Let me double check on that. Yes, yeah, we do have portfolio news. If you scroll down on your dashboard, you will see a news part. It will say all news and portfolio news. If you click on portfolio news, it will give you all the news related to all the stocks you're holding. Yeah. So we do have that.
Okay, so that's our last question. For the remaining questions, would you want to answer sa group chat na lang?
Yeah, if you do have any more questions, please send us to us through our Facebook page or email at investingclub@dragonfly.ph, and we will answer them as soon as possible. So that ends our first part of Brick by Brick webinar series. So thank you all for joining us today. We hope that this series has been valuable in your REIT investing journey. So also, we're inviting you to join us again for our part 2 of our webinar series titled Brick by Brick, Next Level REIT Investing on June 7 at 5 p.m. So if you have any questions, please send it to us, and we'll get back to you as soon as possible. So that concludes our webinar for this evening. Thank you so much for joining, and we hope to see you on June 7.